Hello, friends. If you bought Series EE savings bonds 20 some years ago and forgot about them, there's something about those bonds you probably don't know, and 2027 is going to reveal it. Here's the thing about savings bonds. They're not like a stock or a mutual fund. They don't send you statements every year. You buy them, they sit quietly, and they grow. And most people think that's fine. The bond keeps working. Eventually you cash it in. Easy. Except it's not quite that simple. And there's a specific year, 2027, where a bunch of bonds are going to mature. And when they do, the IRS wants to know about all that interest, all at once. And that's when people discover a bill they weren't expecting. Let me explain what's actually happening here. A Series E savings bond has a maturity period. The bond doesn't just keep growing forever. It has a fixed time, typically 30 years, where it's considered mature. After that point, it stops earning interest. Now, you can still cash it in after 30 years. The money is still there, but once it matures, you've got a decision to make. Most people don't know they have a decision to make. That's the problem. Let me tell you about Robert. He's 62 now. Back in 1997, his grandmother gave him some Series EE bonds for his birthday. It felt like free money to a teenager. He put them in a drawer, didn't think about them for 25 years. Last year, he found them while cleaning out some old files. He was excited. He looked up what they were worth. The bonds had grown from $5,000 to almost $18,000. He thought, well, I'll cash these in next year when I need the money. Problem solved. Inheritance collected, free interest. What Robert didn't realize is that in 2027, when those bonds reach their 30-year maturity date, they stop earning interest. But that's not the expensive part. The expensive part is the tax. Here's how savings bond interest works. When you hold a savings bond, the interest accrues each month, but you don't actually pay taxes on that interest until one of two things happens. Either you cash the bond in or the bond reaches final maturity, which is 30 years after purchase. At that point, whether Robert wants to cash it in or not, the IRS says the interest is taxable in that year. For Robert's bonds purchased in 1997, that deadline is 2027. That's not negotiable. It's not something you can delay. Now, Robert makes about $60,000 a year. He's single. He's in a normal tax bracket, but that year, 2027, when $13,000 of bond interest becomes taxable, his overall income suddenly jumps to $73,000. Depending on where he lives, which accounts the interest gets reported to, and what other income he has, that extra $13,000 could cost him somewhere between $2,000 and $4,000 in federal taxes. State taxes could add another $500 to $1,000 on top. But here's what makes people really angry. Robert didn't receive a check for $13,000. The bonds didn't pay him anything. The money was already in the bond. He's just now being told he owes taxes on it. And this is where some people's situation gets really expensive. Let me tell you about Linda. She's 68. She and her husband bought savings bonds together back in 1995 and 1996. They had 5 different bonds totaling about $20,000 when purchased. Those bonds have grown. They're now worth almost $50,000. That means $30,000 of interest has accumulated inside those bonds. $30,000. In 2025 and 2026, those bonds are going to reach maturity. All that interest becomes taxable. Now, Linda and her husband have some retirement income already, Social Security, a small pension, some investment accounts. Their taxable income is already around $90,000 a year. When $30,000 of savings bond interest gets added to their taxable income, their total taxable income could jump to $120,000. That's not just a small tax bill, that's a significant one. Depending on their situation, that could mean an additional $5,000 to $8,000 in federal taxes that year, plus state taxes, maybe more. But it's worse than just the federal income tax. When your income jumps that much, especially if you're a Social Security recipient, you may cross a threshold that makes more of your Social Security taxable. You may also lose eligibility for certain tax credits. Your Medicare premiums may increase based on your modified adjusted gross income. That single year could cost you more than just the direct tax on the bond interest. It could cost you $10,000, $15,000, even $20,000 when you add it all together. Now, here's the part that makes people really frustrated. This wasn't Robert's fault. He wasn't trying to hide income. He wasn't trying to avoid taxes. He just bought a savings bond decades ago, didn't think about it, and now he's being handed a bill. Except, and this is important, he actually had choices all along. This is where most people miss the actual solution. You can report the interest on savings bonds annually. You don't have to wait until maturity or cashing. Every single year, the bond earns interest. You can choose to report that interest on your tax return, even if you haven't cashed the bond in. If you do this, the interest gets reported gradually, year by year. You pay taxes on small amounts each year, not a huge lump sum at maturity. The problem is, nobody tells you this. You have to discover it yourself or talk to a tax professional. Most people don't know it's an option. So, if Robert had reported his bond interest annually, starting in 1997, he would have been reporting small amounts each year, maybe a few $100s of interest in the early years, building up to more as the bonds got older. His tax bills would have been manageable and spread out. By 2027, when the bond matures, there wouldn't be a surprise. The interest would have already been reported and paid. But he didn't do that. He didn't know he could. Now, he's facing a choice, and it's not a good one. He can cash the bonds in 2027 and owe a large tax bill that year. Or he can try to decide whether to report the accrued interest in 2027 anyway to avoid the mandatory taxable event at maturity. But if he's already waiting until 2027 to deal with it, he's essentially in the same position. Here's what you need to check right now if you own savings bonds. First, find the actual physical bonds or your savings bond account information if they're digital. You'll need to know the purchase date and the series. Series EE bonds have a 30-year maturity period. Series I bonds have a 30-year maturity period as well. Series HH bonds have a 20-year maturity. Second, calculate when your bonds mature. Add 30 years or 20 for Series HH to the purchase date. That's your deadline. That's when the IRS becomes involved, whether you like it or not. Third, if that date is coming up in the next few years, talk to a tax professional. This is not the time to guess. The tax consequences are real. A tax accountant or CPA can look at your specific situation and tell you whether it makes sense to report the interest annually starting now, or whether another strategy makes more sense for your situation. Fourth, if your deadline is more than 5 or 10 years away, you have time. You can make a plan. You can decide whether to report the interest annually going forward, which will reduce the surprise later. The person who really got this wrong is the person who waits until 2027 arrives, cashes their bonds, and then gets a tax bill they didn't expect. That's entirely preventable. But you have to act before that deadline. And here's something else. If you inherited savings bonds, the rules are different. The interest that accumulated before the death of the owner gets stepped up in basis. You potentially owe taxes on less, but you still need to know the maturity date. You still need to plan. The final thing I'll say is this. Savings bonds are supposed to be safe, boring, reliable. They are. The interest isn't going anywhere. The money is there, but the tax consequence is also there, waiting, and it shows up whether you're ready or not. The difference between Robert paying $2,000 in taxes spread across years or paying $8,000 in one unexpected year was a single choice he didn't know he could make. So go find your bonds, check the dates, figure out when they mature, and if that date is closer than you think, don't wait. Talk to someone who can help you plan it properly. Because the worst financial mistake isn't usually making the wrong decision. Sometimes it's simply not knowing you had a decision to make at all. Thanks for watching.